Good evening. Tonight, I thought we're going to talk about something very different. But before I got started, as you may wonder, is why I make or produce most of the videos the way I present them, with me being here in the room, sitting here and talking to you without having a microphone in front of me and background images and stuff like this. That is quite simple. Many years ago, I moved to Hawaii, to Oahu, and I was able to live out there for 10 years. And I had a wonderful, wonderful time. And I was fortunate to get involved with the native Hawaiian people out there. And I made quite a few friends. And I dated some of the Hawaiian girls, which was a wonderful experience. But one of the most interesting experiences I actually had was with a Hawaiian fellow, by the name of Big Richard. And Big Richard had an innate wisdom. And in one of the conversations I had with Big Richard, we would meet in a diner out in Kalihi, for dinner. And we talk out there over local food. And Big Richard asked me one day, he said, "Peter, how many eyes do you have?" I said, 2. "How many ears do you have?" 2. "How many mouth you got?" I said, 1. And then he looked at me and he said, "What does it tell you?" And there's a time and point where we have to listen and we have to learn to see and to say very little. And this is why I make the videos the way I make them. So you focus on seeing eye to eye and you listen. And with that, I hope I can transmit my knowledge I have and whatever wisdom I may have, and I can present to you. In our world today, with short videos and TikTok and Snapchat having basically taken over, and then Instagram, which is being really on the picture side of things, we have gotten to a point that the attention span of most people have gotten very, very low, and they can no longer pick up on a prolonged conversation or have lost already the ability to listen to another person speak for more than a sentence or paragraph. And that is difficult because this is the basic foundation a person actually needs to find serenity and peace of mind. This is not going to be my topic, but I'm just trying to explain the basics in serenity and the ability to listen to other people, not just me in general, but in general life. Texting, to the short extent what we do, Twitter, limiting the amount of characters you can tweet out, have shortened everything, and with it comes the issue or the problem which has arisen that people have a short attention span, and they also have a very hard time to find serenity and peace of mind. Peace of mind is the quietness of the mind, where your thoughts are not racing anymore, and you actually are at peace within. The racing of thoughts can stop when you watch videos where people talk. And as more as you watch people talk, as more you will find yourself getting out of yourself, out of your own head, by actually paying attention to what another person is talking about. And that is basically the beginning of peace of mind and serenity. Now, tonight's topic is, what is money? What is making money out of thin air? or printing money out of thin air, actually, what does it mean? Where does it come from? And how does the American banking system play a role in this? What is a fiat currency versus a commodity-based currency? What are the advantages and the disadvantages? And the reason why I'm making this video is because I think there is a lack of understanding, or there's just not enough information out there, which is a truthful and correct, and I'm trying to be as truthful and correct since I have no financial motives in making these videos, rather than to transmit a objective, neutral picture in this. Now, we know from history that money was not there, but people traded items. People came together for a long time, for thousands of years. And sometimes they needed an intermediary to facilitate their trade. They would use colored stones, anything was difficult to get as an intermediary. Or shells, for instance, like the Hawaiians did that with certain items they found which they considered to be valued to them, which were shells. And out of this evolved the idea of having money, or a intermediary, because that's really all what money actually is to facilitate, it's a means to facilitate trade. It's a storage of value. So I have something I produce, I make, say, like pots, clay pots, and the other guy makes something I need. So I could swap him my clay pot for whatever he makes. But if he doesn't need right now what I make, then I could say, I give you something else of an intermediary storage, which has a value to both of us and other people. And he takes that, and I can get from him what I need right now. And then he goes and spends that on something else, and then that person comes back to me because he needs a pot. So that's kind of the idea behind money. That's really the only thing was ever meant to be, was to facilitate and simplify trade. So this money could be in form of cash, as we know it, as a printed piece of paper or a coin. And the coin could be, for instance, of a commodity which has a high value, which is difficult to mine, say like gold, for instance, gold mining. And a gold coin is very valuable to most people. Gold, silver, all of the minerals which have to be mined, which are scarce, have usually a very high value, especially when they can be also converted into jewelry, something you wear, something you can show off, something which displays status and prestige. Gold, for instance, is has been for a long, long time in the human, trade business, been one of the most valuable trading commodity and intermediate storage of value. Silver also, but nothing has been as important as gold. So many countries had either a paper currency, which was tied to gold, so where the government had the right to issue the paper money, the paper currency, and the government then would say, well, you can convert this to gold if you want to, if you rather want gold, or you can keep the paper money. That's how the trust was actually developed. And some countries also issued then minted gold coins, which complemented the paper currency. So you could immediately exchange a paper note to a gold coin, for instance. in the appropriate value, whatever the value was at that time. $1, $20, $1 eagle, gold eagle. And at one point, they were exchangeable 1-to-1. So an ounce of gold was basically a $1. That was the starting point for this whole system. And then in the 1920s, when the stock crash came, the Dust Bowl started to happen here, and you had massive unemployment in the United States. Theodore Roosevelt took America off the gold standard itself. And what he did is he disallowed the American people, U.S. people, to own any gold whatsoever. That was outlawed, basically. All the gold had to be turned in. I think it was 1932, and they got paper notes for it, and the bank in the United States would guarantee that money. That was the guarantee given. And America was already such a powerful country that they could do this. But now what we have now what we call a fiat currency. And a fiat currency basically lives only of the reputation of the country and the government. So if the country or the government establishes a fiscally responsible, situation overall with government spending and, the amount of money in circulation, then the system will work. And that's what we had. So Roosevelt didn't take America completely off gold, but he allowed the American people to no longer own any gold. And that has been like this, I think, until the 1990s, until that actually was taken off. But I'm not exactly sure exactly what the time was when the restriction of U.S. citizens to own gold was ended. I think it may have been in the 1980s, it may have been in the 1990s. I'm not exactly sure. Then World War II basically started, and the United States had now Fort Knox full of gold because all the citizens had basically sold the United States government their gold coins or gold they had, except for jewelry, gold, and knife, eating utensils and that sort of stuff. That didn't have to be turned in, but all gold coins and everything else had to be turned into the U.S. government, and they were exchanged into U.S. dollars at that time in the early 30s. So Fort Knox at that point was full of gold, and that gold had been remelted into bars, and that is what the legacy is of Fort Knox. That was the American gold. The government kept all the gold there, and that was it. And of course, they were still, mining gold here in the U.S. We have gold mines here out in the West, and in up in Alaska, where they have been mining for almost over 150 years now, and these gold mines are still producing gold. And the government was buying that gold up as well, unless it was used for medical purposes like teeth or jewelry. That was the two exceptions for this stuff. But the gold coins and everything else, gold bars and everything else, that was sold, and it was here. So the U.S. currency in itself, or the government, was backed by thousands of tons of gold, which were actually physically located in Fort Knox. And then came World War II, and the United States issued bonds, quite a bit, war bonds, that's what they call them. They borrowed money from the U.S. citizens. They put an interest on it, and people bought them to support the war effort, and that basically paid for the entire war machine, for the armament of the United States military to fight in World War II. Towards I think it was 1943, the three powers, the United States, the Soviet Union, and the United Kingdom met in Yalta to talk about the settlement after the end of the war. During the same time, the Western non-Soviet allies also met in New Hampshire at the Bretton Woods Hotel. And here they were working out a economic system where the dollar would be the dominating currency, and the foreign governments would be able to exchange the US dollars they were holding for US gold in Fort Knox if they wanted to. That was part of the Bretton Woods Agreement. And that was an assurance that the countries could get gold if they rather decided so, rather than buying, American-produced goods and products or agricultural products, whatever it might have been. Or they could have exchanged it for gold. And this was like a total of 40 countries or 44 countries in 1943, which agreed to the Bretton Woods Agreement. And then when the war ended, West Germany at the later point then joined in on the Bretton Woods Agreement with the West German Deutschmark that was then tied to the dollar as well. When that was all established and West Germany, as a republic was founded in 1949, that became part of it. And then that went pretty well through the 1950s. And with the Marshall Plan, all of the stuff basically restructured and rebuilt Europe, not just West Germany, but France and Italy, all the other countries in the western side, which were basically, had suffered from all of the World War II issues or damages, basically. In the mid-60s, the United States started, actually it happened a little bit earlier, it happened like in 62, in 63, when John F. Kennedy got killed in Dallas, Texas. They put Kennedy on the Air Force One in his coffin, and as soon as the coffin was in there, and Miss Kennedy, what was her name? Jackie Kennedy, and their two children were in the back next to the coffin of the Air Force One, that was the 707. Lyndon B. Johnson was in the front of the aircraft with the Chief Supreme Court Justice at the time, and he was sworn in as president before Air Force One ever left Dallas, Fort Texas. So I think John F. Kennedy may have been dead there by 2 or 3 hours or something like this. But the entire idea, and this is what will explain this of what happened now and why we have inflation today, was that Kennedy sort of was in the way with his philosophy of what Lyndon B. Johnson wanted to do as vice president. And of course, after, Lyndon B. Johnson got then reelected as president in 1964, I think it was, or 1963, whenever they had the election. And he started the New Deal, the Great Deal. And that involved a lot of government spending for minorities, for poor minorities like the African American community. And this entire project started food stamps, welfare, public housing, etc., etc. And all of this money had to come from somewhere. So what the United States did, now remember, the Bretton Woods Agreement was still in place. And because there was only a X amount of gold in Fort Knox, you can't really print a lot of new paper money without devaluing your money if it is tied to a fixed exchange rate to the gold. And the exchange rate back then was $34 to 1 ounce of gold. That's where it had gotten. It was at one point in the 1900s, $1 for 1 ounce of gold. And by 1964-65, it was already at $34. That was an arbitrary value that was not freely traded. Gold was not on an exchange yet. It was not freely traded. So that was government fixed. And the exchange rate primarily was for foreign governments. And so Lyndon B. Johnson was somewhat limited now with the amount of new money he could print to do all of his social projects he wanted to do. Similar situation what Biden has at the moment with his infrastructure program and that other thing he wanted to start to do and spend all of this money and this, that, and the other thing. So Lyndon B. Johnson was somewhat limited with what he could do, but they started to print already more money. And that caused a concern in France, in West Germany, in England, and in Saudi Arabia. Because by the mid-1960s, Saudi Arabia had been developed by the Americans as a major oil producer. And it was the Saudi Arabian oil primarily which went into Western Europe to fuel the entire automobile growth over there to begin with. So these four countries now were looking at this. They were looking at Lyndon B. Johnson. They were looking at his government printing money so they could actually fund the social projects over here. And they started to turn their US dollars they had gotten, in the exchange between Westmarks and pound sterling and French franc at the time, and the oil was already traded in US dollars, so the Saudis were getting US dollars. But basically, they looked at this and they said, well, they're paying us $1 or $2 a barrel at the time. But the exchange rate was basically no longer, it was still $34 for 1 ounce of gold. But the circulation, the money was increasing. So it should have been more like $50 to $60 to the ounce. And what they did is they started to take the US dollars the governments, their central banks had gotten, and they brought them to New York for exchange for the gold in Fort Knox. So they had massive amounts of, armored transports from Fort Knox going into New York to the different banks, and then that gold was distributed from there to England and to France and to Germany. France, England, and Saudi Arabia being the three biggest takers of the gold. And this is where John Gotti came in with his crew out there at John F. Kennedy Airport. That was Idlewild Airport at the time, where they did the Lufthansa heist. And, where they stole all of their gold and cash and everything. And the story is that the UK government, the central bank in London, the British central bank, had gotten so much gold on one flight out of New York that when they brought the gold into the central bank and they put these carts, which were loaded up with gold bars, into the elevator to go into the basement where their big safe is, the floor of the elevator actually broke through physically. It collapsed, and all of that gold and the people which had moved the carts in there fell into the basement shaft of the elevator. Good 1.5, 2 floors below. I think 1 or 2 people died. This is how crazy this was. The other thing is what fueled this entire devaluation of the US dollar at that time was the ongoing and increased Vietnam War, which Kennedy had started. And then basically Lyndon B. Johnson got fully engaged into this. And then we had the election in 68 where Nixon was elected. So, and then Nixon was in the middle of all of the stuff. He inherited all of these things from Lyndon B. Johnson. And the American people were fed up with this. The world was fed up with this whole thing. And Johnson, or Lyndon, not Lyndon B. Johnson, but Nixon was trying to figure out on how to fix this. So in 1972, he pulled the plug completely on Bretton Woods. And the reason for this was whatever gold they had left by 1972, which hadn't gone to Germany, West Germany, UK, France, Italy, Spain, but it was primarily the UK, France, and Saudi Arabia, basically could no longer get any gold for the US dollars. So they could convert this, they could come over here and spend all of that money, whatever America had purchased in those foreign countries, in the exchange. They could come here and buy something for it, where it was real estate, cars, jewelry, you name it, whatever, airplanes. The sky is the limit. But this was basically now the situation. And the response out of this, now we have the result was when Nixon took the U.S. off Bretton Woods, that ended any type of gold backing of the US dollar. And with that, the US dollar became a fiat currency. And in the fiat currency, the monetary system is not backed by any other thing than the government itself. And it's like a fairy tale. It's like there's nothing there anyone could take out of here for that money and get something of value. And we had now a fiat system since, let me get a water, oops. We had a fiat currency system now since 1972-73. America never went back to a gold standard, because they figured it would work. But what happened now is, if you're young, you probably don't. But the response was from Saudi Arabia and OPEC, since they were getting paid in US dollars, they were looking at this, that their money was basically devalued. And that was the first oil shock, what we call. That oil shock originated with the end of Bretton Woods and a fixed pegging of 1 ounce of gold to $34. So if they sold a barrel of oil for $2, that means 17 barrels of oil would equate to 1 ounce of gold. Once you take the gold out of it, at the time it should have been $50 for 1 ounce of gold. So they had to basically double their oil price. So they went from $2 a barrel to $4 a barrel to actually compensate for the increased printing from the social program from Lyndon B. Johnson and the Vietnam War, the cost of it. And that created the oil shock, the first oil shock in 1973. It was basically an adjustment of OPEC to the increased printing of money, which had occurred from like 1963 on until 1972. And it really didn't stop until the Vietnam War was ended. That was another reason why Lyndon B. Johnson, not Lyndon, but Nixon, ended the Vietnam War. For one, is that wasn't going very well. It was highly unpopular here in the United States. And on top of it, they had spent so much money on that war that had increased or it created an inflation. And now OPEC started to adjust their oil price for that inflation. And that caused an oil shock here and over in Europe. So this is kind of on how we got to the situation. And our world really hasn't been the same since. In a fiat currency, since you have there's nothing tied as a commodity to the, to the monetary, to the currency itself. There is no more assurance there that you could get something of value or of perceived value. Gold is something of perceived value. Platinum, palladium, copper, these type of earth, minerals or materials, those have an intrinsic value. You can buy them, but it fluctuates, so there's no more stability there. This entire monetary system has become unstable. So what the central bank here in the United States was, they said we're trying to get to a 2% inflation. Then came Ford as president after Nixon, and then came Jimmy Carter. And during those years, the spending again, the printing increased even more. That created a second oil shock in 1977-78 for the same reason as the OPEC countries were increasing the cost of oil based on the amount of money the United States printed. And this is now government spending, basically, where the government increases the amount of currency in circulation. And they have to control through their central bank and through the treasury. Each country in the Western world is set up with those institutions. And they normally are supposed to be running independent of the government to prevent this. But the reality is, since the president basically nominates these people and they're being confirmed by Congress, you have usually ideology involved in it, and that will steer the overall process, in the Treasury and in the central bank, or the Fed, in this case, on how much money they will print. On top of this, we have that is only one part of it, which covers the inflation part. Now you have another sector in the banking sector, that is the banking sector, and the way this works here in the United States is also based on a model of fiat currency. The way the banks work is that usually the bank has no money until they have customers who open up traditionally a savings account. They bring in their money, and the bank tells them, I will pay you an X amount of percent interest every year when you keep your money deposited here. Now, if they get $100 in, they could lend $100 out. They would pay the person, say, like $1, and they charge the other customer they're lending the money to 3%, 1%, 3%. They would net 2% on the transaction. Now, if the customer who has deposited the $100 comes back one day and says, I need $100, but they have lent the money out to someone else to make the 3% on, then they have to tell the customer, well, we don't have any money to give you. And the guy says, well, where's my money? Well, I lent it out. In order to alleviate this, the U.S. banking system was set up that in order to make more money and don't have to have a one-to-one deposit in there, what I should say is, well, the way they usually do this is they grab, then if you're coming in and you want your $100, but they lend you $100 out, then they will take the $100 out of another account from another customer and will give you that money until someone else comes then back and puts more money in, and they will then put that then in there. So it's all in the books until someone actually comes in with physical cash or a transfer or deposits a check. A check is basically cash in this. Or writes a check out. So that's why the banks usually have a 1 to 2 day delay, because they're working with your money for free to fill up all the holes, depending on if they had more deposits coming in than outgoing during that day, or vice versa. And they have a institution which is called LIBOR, that is the London interbank rate, and that rate applies here in the United States too. That's where the banks borrow from each other money so they can cover the shortfall. Say, like if I have a bank which had 100 million coming in, but 120 million going out today, and it has to be settled tonight, that usually goes overnight, then I have to borrow 20 million for the money I have to send out, which I don't have. So I go to the other bank who had more money coming in than they were sending out, because that's how the customers deposited and withdrew the cash. And that's basically how they're filling their gaps, and they're charging each other a interest rate for that overnight borrowing, basically. And because it costs them money, they don't give you any money until 1 or 2 days later for your full deposit, unless that deposit was made in cash. But even today, when you make an actual cash deposit, it may not come or clears or be available for withdrawal until the next business day or the day after that. Now, back to the loan business and the banking, is what they did is they came up with the ideas, well, we make it lawful in the banking regulation system that you have to hold back only 10%. You have to have available. So I have a customer who comes in and gives me $100. Now, in the first example I gave you, I gave out the full $100 to the next customer, okay? So this is like a one-to-one deal. The chances of defaulting or the bank going broke is fairly limited in this. But you can basically lend then out only as much as you have coming in or holding as deposits. The banks usually like deposits which are committed with them, because they can plan better. Say, like in CDs, 3 months CD, 6 months CD, 1 year CD, 4 year CD. They pay more interest because the bank can now count on it. They know they don't have to give you any of this money back. You could basically request it, but then you won't get any interest. So most people don't do this. That's like almost 100% sure. But now, in order to get more lending activity going, they are allowed to take your $100 and divide them into $10 deposits. So now what they do is they can write out 10 loans, not just for $10, but the regulations allow them to actually add another $90 to it. So they're getting $100 in, but they're lending $1,000 out. You're getting 1% on $100. They're getting 3% on $1,000. And that's how the banks make money. Now, in this whole thing is the Federal Reserve System requires the banks to have a prudent reserve with the Federal Reserve in the amount of 10% of what they're basically taking in. So what they actually wind up doing is, out of the $100 you give them, 10% they have to take, which goes to the Federal Reserve. That is the insurance, that if they go broke, that you're going to get your money in your checking account up to, it used to be $100,000. Now I think it is $250,000, I believe. It went up in the crash in 2008. And then they have $90 available. And out of those $90, they can do 9 deposits at $10 plus $90 on top of it. And that gives them the ability to actually physically lend out $900. You get 1% on $100 you put into your account, they're going to make 3% on $900 they're lending out. And now we have created $800, which did not even exist until the person actually walked in and requested a loan from that bank. That money wasn't there. It is only created at that point. And this is how we basically increase the physical amount of money in circulation. Now, let's say the banks, of course, have very strict criteria on what they can lend out and to whom they lend this out to have the assurance that this money is going to get repaid. They also have to make sure that they cannot lend out too much into one particular sector. So if one sector goes bad, that they don't go bust. And if it ever comes to a run on the money, run on the bank, basically, that's what they call it, where everyone goes to the cash machine to get their cash out of their accounts because they're worried that the bank goes bust is because of this. That's why the FDIC, the Federal Deposit Insurance Corporation, insures each bank account, checking account, savings account, and certain other money market accounts up to $250,000 per insured person. If you have more than $250,000 in there at the time the bank goes bankrupt or in receivership actually with the Federal Reserve, then you're basically out of luck and you have to wait until they settle the whole thing and then see what comes out of it. But the entire purpose now is that we actually can increase the money in circulation through loans. And the biggest tool we have here is mortgages, because that's really where a lot of money comes in or is generated from. And in the inflationary process, this is why a hot housing market is never really that great, because it automatically starts to increase the amount of money in circulation. And normally, say like if I'm a developer and I have a piece of property, I bought the piece of property in cash, say like I bought 10 acres for $5,000, just to give you an example. I'm going to break those 10 acres up into 1 acre lots. Then I have 10 lots. Now I need to go to the bank. I need to put streets in there. I have to put a sewer line in there. I have to put water in there and electricity and all of this stuff. And, I have to pave everything, grade it. I have to file for the permits to do this with the city or county, what have you. So I need, say, like $50,000. So I go in and I say I paid $5,000 for the lots, but I need a $50,000 loan from you. So what the bank is going to do is he's going to give them the $50,000 based on what these lots are going to be selling for, because I have now 10 lots, and say like I have 10 lots at $5,000. So this is the idea behind it. So I do the work for like $10,000. I got $5,000 of my own money in there. So $15,000, I will clear out $35,000 by the time it is all said and done. Then I have sold 10 lots and they can build their homes on it. That's the idea behind it. So the first beneficiary of this newly printed money is actually the construction company who's going to do the physical grading of the properties to divide this into the 10 parcels. The guy who's out there with the shovel digging the ditches for the sewer, the guy who's running the machines to grade everything, to pave it, and that sort of stuff, to put a street in there or little driveways, to put the electricity in. Those are the first people who are going to see the new money. And of course, if they increase their pricing, then that new money has to be more in order to cover the expenses. That means I have to charge more for the parcels I'm selling. The next beneficiary of this newly printed money is going to be the construction company who's going to build the new home. So I have now a willing home buyer who has bought a model, of home, for instance. I have 4 or 5 models. I have a contractor, they can build it. So they choose model A that costs $250,000, including the $10,000 for the lot, or $5,000 for that lot, for that 1 acre. That construction money now, they go to the bank, they have to put 10%, 20% of their own money in. The rest of it comes from the bank out of thin air. There's nothing there in cash to actually cover this. And the only reason that this works is that this is all book money, because that money is sent out from the mortgage or from the bank to to the contractor as it goes along when they build it, and then the contractor gets it into his account, and until they actually start writing checks, nothing is there. It is just automatically created out of nothing when the bank issues the first check. They don't have to have anything there besides that 10% which came in as a deposit from one of their depositors, any person with a checking account. They don't have to have anything at all there for that money. They can do this only to a certain volume, because with that goes back to the 10% deposit they have to have with the federal deposit, insurance company, through the Fed. But then basically that money didn't exist until you signed the dotted line on the mortgage, minus your actual deposit you have. So if the house was $250,000 with lot, and you have a check for $25,000, then the bank signed $225,000 minus 10%. $200,000 were created out of thin air. And that $200,000 is going to go to the contractor, to the electrician, to the plumber, to the city, to the, everyone who's involved in it, the carpenters, the sheetrock people, everyone. Those are the people who will have the immediate benefit of newly printed money. It's new home construction. And then from there, it usually goes into the further economy on a fairly limited scale. It goes for the building materials, which then go to the, lumber people, people who make the PVC pipes, electrical supplies, and so far and so on. That is the actual printing of money, or the increase of money in circulation, is through the housing market, done through the housing market, with very little capital on their own from the banks. That's a 10% limit. So if a bank has $100 million in deposits with the federal deposit, with the Fed, basically, they can basically lend out an additional $900 million on that, for a combined volume of $1 billion out of nothing. And you do this with $100 million, these numbers become astronomical. And that's how the whole housing market crashed in 2008, because the people who had borrowed the money, not just necessarily from banks, but also from, loan companies, which basically work the same way because they are regulated by the banking system. And it became bigger and bigger. And when these loan corporations couldn't print any more money because they were at the limit, they went ahead and they sold the mortgages they had issued already, where there was money coming in because the people were buying them. They bundled them up and they sold them to Wall Street. So if they had issued $100 million worth of mortgages, they would take those mortgages and sell them to Wall Street, And then they had another $100 million. And then they could start this whole process over. And that's how this thing got bigger and bigger and bigger. And this is the reason why people like to flip homes, because you can get a construction loan and you take an old home and you put value added into it. Through the construction loan process, you're creating more money in circulation, which then has to be financed with even more mortgages, because now the house is even more expensive. And that's how our rents got up to the point where we are, because a lot of people did this. And this system is flawed, and it is only a matter of time until something is going to give in this. The only way it works is if you have full employment, but you cannot have the government print any money to jeopardize this, what is coming already, what is being printed by the banking sector. So if you have the stuff with the coronavirus, that made up, increased the regular money production basically, and now you got Biden in there. That's why they're not excited of Biden and his whole monetary agenda he got there with all this additional spending, because it comes on top of it. So this is why this whole thing started to mushroom on us. The banking system itself, with the mortgages after 2008, they had that now stabilized with the banks, that the inflation this creates would be around contained about 2%. And because it is primarily the construction sector which benefits from this first, and then it trickles down to the pizza parlor and the movie theater, depending on where the construction workers spend their money and what they order off Amazon and that sort of thing. That's then the secondary beneficiary market where that trickles in. But that's basically where that is coming from. So they're trying to hold us at 2%. If the government starts to give out and spend more money on infrastructure projects like what they're going to do, and other projects which Biden hasn't been able to get through yet, that $4 trillion package, but this will get your inflation going through the roof. And that's basically what we have seen. And the adjustment again to the oil market is the same result from OPEC out of this, because they look at the increased volume of money in circulation. So I hope that this kind of explained this whole topic to you. It's probably pretty bone dry, but if you have ever wondered where the phrase comes from, making money out of thin air, that's basically it. Because when you sign the dotted line on that, 90% or 80% of that mortgage, 10% you, 10% the bank, 80% comes out of nothing. It is generated that second when that mortgage is signed and approved. And the bank simply opens up that account with that new balance on a computer. Has never existed before. It is born that minute, and it has increased the currency in circulation by that 80%. You buy a house for $100,000, $80,000 in that instant is coming out of nothing. It didn't exist until the ink hasn't even dried yet. By the time you start signing your name on the dotted line, and they agreed to this, that's when it comes into existence. Then they go on the computer, they type it in, and boom, there's $80,000. Just like that. Didn't happen. You didn't really do it. It is just on how the system works. There was one president who said that in the 1910s or 1920s, when the system basically was set up, he said, if the American people would know how their banking system worked and truly understand it, there would have been a riot already. That was in 1910, 1920. But this is America, the land of dreams and the land of possibilities. And that's what it is. You have a great evening.